Welcome to our fourth CFO Insights, an interview program sponsored by FLG Partners, where we showcase the talents of our partners through a discussion of a particular subject of relevance to our audience and how that partner has navigated the issue during his or her career. Today, we will be discussing how to take life science companies public in today's turbulent market with one of our most esteemed partners, Eric Hall. He will walk us through to SPAC or not to SPAC. That's my ode to Hamlet, by the way. Eric has been with FLG Partners since 2004 and has over 30 years of senior management experience as a president, COO, and CFO at both public and private companies. His specialty is building successful organizations from the ground up and then helping them navigate their strategic options, such as financings, IPOs, M&A, or successful exits. Eric's most recent assignments as an FLG partner have been focused on helping life science companies build their finance teams, manage successful financings, and then take those companies public. Most recently, Eric was with ALX Oncology, an immune oncology company which had their IPO in July. He helped them prepare for their IPO until a full-time CFO was hired. At Rapt Therapeutics, an immune oncology and autoimmune disease company, Eric managed 2 attempts at an IPO. While the company had to delay their initial offering due to the overall market decline in July of 2019, they later went public on Halloween, mind you, and became one of the top 5 life science IPOs last year. Lastly, at Singulex, a medical device and clinical lab company, Eric helps them secure $100 million of financing, both equity and debt. So with no further ado, let's begin our conversation with Eric. So glad you've joined us today, Eric. Welcome.
Thank you, Laureen.
So my first question is this. So the past 3 years, Eric, you have focused your practice on working with private life science companies and helping them navigate their financing needs, including IPOs. First, tell our audience what happens when you first come into these companies. At what stage are they, and why is the company bringing you in at that particular juncture?
Most of the time I'm coming into the company when they need to complete a crossover round of funding. This is a pre-IPO round where you bring in investors that are active in venture funding and public markets. My role is to identify, connect, negotiate, and close the funding round. At Rapt, we brought in an additional crossover investor to improve insider participation in the IPO. Once the funding is underway or completed, my focus then turns on preparing for the IPO. And this involves conducting investor banker bake-off to establish the IPO syndicate, selecting corporate underwriters counsel, financial printers, stock transfer agents, and the listing exchange, choosing D&O insurance broker, and finally completing the audited financial statements necessary. There's a lot of moving parts to get lined up for an IPO.
And a lot of expense that goes with it, right, Eric?
Definitely.
So at the particular inflection point when the company brings you in, Eric, tell me about the finance team. Are all the necessary functions in place? Is the quality there? Or do you have to build the team to ensure that the future financing will be successful?
Laureen, every company is different, and that's what makes it challenging and exciting for me. Rapt probably had the best control I've worked with in a long time. We had a small, talented finance team that she had handpicked, and we outsourced when we needed help like FP&A. At ALX, we had a good controller and a small finance team that needed to expand to meet public company requirements. And I'm now helping build the financial team of my current client who wants to go public. It's challenging since the finance team will be in China. So at each client, you need to assess the finance staff and make the necessary changes to meet the increased demands of the public company.
And oftentimes, am I right, that means that you need to upgrade the team?
You definitely need to upgrade the team.
Yeah. So my next question is about when's the right timing for an IPO? So how do you help the CEO and the board decide whether the time is right to do either another private round or actually moving to the public markets? What is the trigger for making the call either way, Eric?
Well, market conditions are always a factor. Is the market receptive to IPOs in life sciences? As we saw last July, the market closed in the last week.
Mhm.
Are the public-private institutional funds like BlackRock, Fidelity, Wellington, or other crossover institutions investing in the life science industry? Has the company outgrown the ability of VCs to provide funding? Do current investors need to show an exit and an ROI for their investors? Clinical trials are very expensive these days.
Hmm.
IPOs have replaced VCs as the source of funding for phase 2 clinical trial expense and beyond in life sciences. Besides traditional IPO, going public via special purpose acquisition corporation, also known as a SPAC, is another way to replace VC funding or a mezzanine round of private funding as part of the company's plan to secure a 5-year runway for financing clinical development. So how much funding is needed in the next 2 or 3 years or longer? What are the sources of funding? Public, private, both? And what is the timing of the need for financing? These are the questions the CFO needs to ask and provide answers for. It's up to the CFO to weigh all the alternatives and present a sound recommendation to the CEO and board of directors. This is where consulting CFOs from FLG Partners can provide expertise, analysis, guidance to our clients.
That's a great synopsis, Eric, on kind of the when and the why to go public. And oh, by the way, thank you for the FLG plug. Appreciate that. So my next question is about the SPAC concept itself. So to the extent the decision is made by the company to move to the public markets in today's turbulent marketplace, are you looking at SPACs rather than the traditional IPO? Tell us about SPACs, Eric, and how they are actually used.
Well, we're definitely looking at a SPAC as a viable alternative to a direct listing or traditional IPO. But first, it's important to understand what a SPAC is. SPACs have been around for a long time. In 1990, there were only 2 versus today in 2020, there have already been over 140.
Wow.
SPACs are definitely on the rise and definitely becoming very popular. A SPAC is a public shell company that has raised money from investors, usually institutional, for the purpose of acquiring a public or private company. SPACs get a blank check to find the targets or targets to acquire. SPACs have 2 years after they raise their money to complete an acquisition. During that 2-year period, SPAC investors can get part or all of their investment returned with interest if they do not approve a target acquisition or spend all the money raised. It's really a win-win for investors into the SPAC.
There's no risk.
No risk at
When you
all.
think about it, right?
You get your money back plus interest. Not a bad deal. Investors in SPACs are betting on the reputation and our experience of the SPAC sponsors. The target acquisition doesn't go public, and this is really key here. It's acquired by a public SPAC and is public via reverse merger, essentially an IPO through the back door. Life science companies have been targeted for acquisition by SPACs. Life sciences are backed by buy and hold institutional investors, which makes them very attractive to SPACs. Once acquired, you're not going to see your shareholders unload those shares in the market and drive prices down.
So I just want to mention one other thing before you get into the difference with direct listings. And I think a very important point that you made, Eric, for our audience is that the target company in a SPAC situation, the target company merges into a SPAC vehicle that's already public.
Right.
Exactly. So
Okay.
you are now going to talk a little bit about the differences between SPACs and direct listings.
Compared to direct listings are not a realistic option for life science companies. Life science companies usually lack some or all the following prerequisites necessary for a direct listing. Revenue. Most life science companies are pre-revenue.
Exactly.
A tested business model with growth. Public awareness, both institutional and retail investors. For example, most life science companies do not have the public awareness a Palantir or a Snap did for their successful direct listing IPOs. And then widespread use of the company's services or products. Again, these are companies that are pre-revenue, pre-commercialization. They're in clinical trials, so the public's not going to have access to those therapies or treatments.
I totally understand that. So basically, SPACs essentially provide safeguards for investors in life sciences that a direct listing via an IPO don't have, correct?
That's correct. That's correct.
Got it. So Tell us why, Eric, SPACs have become the vehicle du jour almost in terms of taking a company public. What is actually, and I guess my question is, what is actually happening in today's market that is causing SPACs to be so popular, much different from 20 years ago? And why are they so popular amongst the life science companies?
Well, from the sponsor's perspective, SPACs have become popular because PE and VC firms can raise a tremendous amount of money without all the hassles of a limited partnership or the investments impacting their fund IRRs. So I can start up a SPAC without impacting my existing fund. SPACs don't leave money on the table. The acquisition price per share is negotiated, not set by the public market. So what you go out at is what you actually receive. SPACs are all about speed to market. It's quicker and easier to go public through an existing SPAC public shell. A traditional IPO or direct listing can take 6 to 18 months. A SPAC acquisition can take 2 to 4 months. You can also raise more money in the public markets than you can in the private. That's why they're very attractive, because you're looking at clinical trials in excess of 150 million. That really tests the limits of what you can do with your traditional VC syndicate raising another preferred round.
So totally get it in terms of why SPACs are so popular today. Can you tell us a little bit more, Eric, a little bit more in detail about the pluses and minuses of using a SPAC, particularly in the life science sector, and then how you as a CFO influence the decision-making process to do a SPAC or not to do a SPAC?
Well, the goal of the company is to get access to the public market for current or future funding rounds. The public market is larger and more liquid source of funding for a company's R&D and clinical trials to get their products to market. But key to remember, a SPAC is not an IPO. It is a merger of a private company into a public company shell whose assets is a large sum of cash. The CFO is integral to this decision. The CFO lays out the scope and objectives and the cost for a traditional IPO versus a SPAC offering. This includes both qualitative and quantitative factors in the decision. The pluses of a SPAC are speed to market, since you don't need to go through the IPO process of audits, IB syndicates, drafting and filing an S1 with the SEC. It's a lower cost versus an IPO. IPOs run anywhere from 7 million on up when you include all the investment banking fees, legal fees, and audit fees. Simpler filing with the SEC. No retail investors to deal with. You leave less money on the table, and you can't underprice the offering. You set the price, and that's what it is.
What it is.
Yeah, the minuses of SPACs are you're public and you're not prepared for it. You know, you've just gone public through the back door, and all of a sudden now you've got to do your audits, quarterly reporting, SOX and regulatory plans, all requirements you have to get done in that first year. The SPACs, retail investors come in later. SPAC sponsors and investors get their money out first. Retail investors in the mutual funds holding the shares or holding direct shares take on greater risk. Your company will incur a higher cost of being public. There are hidden costs for a SPAC in terms of the value of the equity given to a SPAC sponsor, 1 to 5% of total funds raised versus the total fees paid to investment bankers, lawyers, auditors, consultants, and other IPO costs. A SPAC acquisition is a one-time deal. The company will have to raise future rounds on their own. Funds raised from a SPAC must cover 20 to 25% of the next 5 years of R&D and clinical trial costs. That's very important. A SPAC is not going to raise all the funding you need for the next 5 years. The company's ability to raise the remainder will depend on how their clinical results come out. Bad clinical trial results equal no follow-on funding. So you have to deliver. As we say, you go public on the vision, future rounds are raised on the data. The same is for SPAC targets that are required.
Totally. That's a great synopsis of the pros and cons of using a SPAC within the life science sector to become public. And I hope our audience, has appreciated the whole listing of the pluses and minuses. That was a great summary. So let's now turn to how one prepares to go public. So is the preparation, Eric, any different in going public by using a SPAC vehicle rather than a direct listing?
Yes, with a direct listing, it's the same as going public using an investment banking syndicate, except you're the IB syndicate. You have to do all the SEC requirements, including the S1 on your own. You have to do all the marketing, selling to the public market. You don't have IBs building the IPO book for you. You've got to do that. You're getting the commitments from institutional investors. And finally, you're setting the price without the help of the investment banks. You still have the risk of leaving money on the table if you price too low, or having a hung IPO if you price too high.
Mm-hmm.
With a SPAC, going public is a reverse merger. The SPAC is already public, so there's no need for you to file. Once the SPAC sponsor is funded, the SPAC acquires your company and you're now public with the same requirements as any other public company.
Got it. So how do auditors, Eric, handle a company that is going public through a SPAC? Is their diligence at a different level, and is their cost at a different level as well?
Well, remember, this is an acquisition. The audit will come post-acquisition and the target company will need to be prepared. Depending on the timing, you could have a little or a lot of time to prepare for the audit. The SPAC will perform their due diligence on the target company, which may include a review by their auditor, but you're not going to be going through a full audit as the acquired company. The good news is that you can execute a SPAC quickly without the higher cost of this public company audit, but be aware, once you're public, you will include these higher audit costs. The cost of an annual audit can increase from an annual cost of $50K when private to $500,000 or $1 million or more once you're public.
So the bottom line is, even though the costs may be a little different when you're going public through a SPAC vehicle versus a direct listing or through a bank or syndicate, at the end of the day, once you're public, each doesn't matter in terms of the ways of going public. You're going to have those increased costs no matter what, right?
That's correct. That's correct. You can't avoid the cost of being a public company.
Exactly. So are there any issues that are peculiar, Eric, to using a SPAC to go public? Any issues, for instance, regarding the board, D&O insurance, all of those things that one needs to do to become public? But is there anything peculiar with the SPAC than with the other ways of going public?
Not so much peculiar as you're still going to have a lot of the things in place. Like D&O insurance is going to have to be increased once you're public. It's a huge cost increase that most boards are not prepared for. Public company D&O insurance premiums can be 10 times or more than the cost for a private company. 1 million in premiums is usually at the low end for a public company D&O insurance. You're more likely to see premiums in the 2 to 4 million range based on the coverage you select. The board of directors will have to be compensated and new committee charters will have to be drawn up. Your old private charters don't work in a public company. And board of directors need to be paid because they are taking on more risk and also more duties. Committee composition will probably need to be changed to include more independent auditors, independent directors, particularly on the audit committee. You can't have management being part of the audit committee. You're going to have independent directors. And diversity will also need to be addressed to meet California legal requirements and the changing corporate ethics requirements.
And these are, again, requirements and costs that are general to going public, meaning, again, whether you go public through the vehicle of a SPAC or an IB syndicate, or you go direct, these are all the things that you're going to have to do to ensure that you maintain a strong and good public entity, correct?
Yes.
Yeah. So let's switch now to what you're doing currently. I know that you're working with a company in life sciences, and I know that you guys are thinking about going public. So are you, Eric, contemplating the use of a SPAC in your current company?
Unfortunately, we're not. We're going public the traditional IPO way.
Why? Tell us.
One of my clients is a life science company that is going public, and they're a foreign filer operating in China. We need to maintain that offshore status to minimize our U.S. tax exposure on global revenues. So we decided not to go the SPAC route. For other life science clients, however, a SPAC option can be very appealing and needs to be fully evaluated.
But I understand in your situation, because you guys are a foreign entity and the whole tax situation, got it, why the SPAC doesn't make sense. Totally get it. So my last question, Eric, has to do with trends into 2021. So are you seeing, or do you foresee an increased use of SPACs to take companies public, and not just in life sciences, but in other areas like CPG, tech. What do you feel about this trend? Is it good? Is it not good? What are you prognosticating into 2021?
Well, I see the use of SPACs increasing. With 140 out there and growing, it definitely is going to happen. But there are pluses and minuses, and you need to use them wisely. Are there good enough target companies out there waiting to be acquired? Will the acquisitions yield the expected returns for all the investors? And will retail investors end up losing their investments if the SPACs are not successful? We'll have to wait and see how this new round of SPACs play out. I'm hoping they are successful for business, sponsors, and the economy. Now, our partners at FLG Partners are uniquely qualified to help you navigate between traditional IPOs, direct listings, and SPACs. We have many partners who have taken or assisted our clients in going public in life science, SaaS, and other industries. Maybe we can help you take your company public.
Thank you again, Eric, for that FLG plug. We love it. Your summary of to SPAC or not to SPAC, particularly in life sciences, Eric, was great. And I hope that our audiences appreciated the work that you've done in helping us in terms of this educational interview today. So thank you for joining us. And again, it was a great discussion of life science companies, the public markets, and the use of SPACs as a vehicle to take a company public. And I hope our audience found it useful. And speaking to our audience now, we know that this is an extremely hot topic. So I'm excited to share with you that FLG Partners will be offering an online 2-hour workshops for CFOs and CEOs, and it's solely about SPACs, and it will be December 9th. Tune in, we'll get out to you all the information in terms of registering and joining us. We're very excited about that. And then lastly, as I've mentioned to you before in our interviews, we are planning our CFO Essentials workshop, now scheduled for March 4th in San Francisco, pending all of the social distancing guidance, but we think we're going to be able to make it for the 4th. And again, we'll be sending out registration information on that after the 1st of the year. So thank you everyone for joining us today, and thank you again, Eric.
Thank you, Laureen.
Thank you. Bye, everyone.